This is Don Durrett, Gold Stock Data. Today I'm interviewing Kristina Walcott, the CEO of Freegold Ventures. I've been a big fan of Freegold for a long time. It's one of the better, what I call optionality plays in the business. And the reason why it's such a strong optionality play is because the size of the project, it's massive. So right now, I mean, you have a resource of 22 million ounces at 1 gram. I mean, 22 million. I mean, it's kind of mind-boggling, the size of this thing. And it's a single pit. Like, you look at this thing and you go, oh my goodness. And then we look at the valuation, and it's like nobody wants to give you value for it. But then I create these optionality lists of all these companies, and you're not unique. It's like nobody's getting any value. So you basically are in that bucket. But at a certain point, and this is why I like it as an optionality, the rising tide is going to lift all the boats. And the value of your gold in the ground, like right now, it's under $20 an ounce in the ground. And my first question to you is, I actually think that my understanding is that if the price of gold goes higher, your cutoff rate can go lower and the size of the deposit can get bigger. It's like you're announcing it at 22 million, but in actuality, if gold prices go up or they stay the same, aren't they going to mine more than 22 million ounces?
Oh, I think there's always going to be that. Obviously, we have that flexibility in the cutoff grade. I mean, we have looked at a 1 gram as sort of being that sort of magic number, and we want to continue to increase that. You never know what happens with the gold price. I mean, we're certainly very bullish on the gold price, but what we really want to do is bulletproof this deposit. So, if the gold price corrects, we're still a very viable project. And that's really what we've been focusing on for the last few years. You would have seen huge accretive growth in the resource size. When we did the PEA back in 2016, we were using 3 million ounces, an average grade of 0.69. So, you can see that, and as we've grown, the project is also unique. And I think a lot of people don't necessarily understand that we've really only been at this since 2020. I mean, we really finally had the money to sort of really do the project. We've now drilled 130,000 meters. So big drill program. But with every round of drilling, what we're finding is as we tighten the drill spacing, we're able to get higher grade. So I think that's going to be another sort of tick the box moment. As we move through, I think I told you, we're going to be trying to move through pre-feasibility this year. So a lot of that 22 is caught up in the indicated and the inferred. So we're looking at about 12 million indicated right now, about 10 million inferred. So the idea of this year's program, 30,000 meters, is upgrade that inferred into the indicated. Again, try and bump that, and then keep working on the metallurgy. That 22 is also looking at a 72% recovery rate. We took the approach, we wanted sort of plain Jane processing, just gravity and CIL. We get between 40 to 50% with just gravity. We thought, okay, we've got some optionality here again, if we just did this plain Jane. Now, of course, what happens at 72? Can we get that recovery to 90%? So that's where the additional metallurgical work is coming into play right now. Try and seeing if we can boost it that way as well.
Right. Just to follow up on the question now, if you did lower your cutoff, the resource would increase in size, isn't that?
Absolutely.
That's correct.
Absolutely.
Right? I just wanted, so for me as an investor, the way that I look at it is how much gold is economic, how much gold is there. It's all about ounces. How many ounces are they going to mine, and then with the valuation? Because your project, you're a pure exploration company. You're not going to build this. You're going to sell this. Or you could JV it. Those are kind of your only two options. And so if you sell it, you want to sell it at, the way that I look at it is how many ounces are there, and then how much you're going to pay per ounce. Is it you're going to sell it for $50 an ounce, or you're going to sell it for 80 or 100? And then it's how many total ounces you find. That's why companies don't sell early. They want to find out how many ounces are on our property. We want to drill this thing out. We have all this property. We want to drill it out. We want to find out how many ounces, and then that's how our valuation is going to be. So if, like right now, you have 12 in indicated, 10 in inferred. So a company maybe won't give you full value for the inferred. Maybe they say we're only going to give you, say it's 18 million ounces, but that's at your current cutoff. 18 million, but maybe it's 25 at higher gold prices. Now, as gold prices go higher, as they go higher, because you said we want to be confident in case prices go down.
Absolutely.
But if prices go up, and then what happens is over time, companies use a higher threshold for like their PFSs and their PEAs.
Oh,
and
absolutely.
at a certain point, it can go up. But I guess where I'm going with this is that you have a lot more drilling to do on this property. You're finding high grade. Your drill results this week were phenomenal.
Oh, we were super pleased with that.
I mean,
Absolutely.
I'm going, this
Fantastic.
has to be infill drilling. There's no way that a property of this size, 22 million ounces, there's no way that this has to be infill. And it's not infill.
It's expansion, and that's what's neat. So it's a unique project in the fact, and to your point, yes, absolutely. You know, as the gold price goes up, you know, obviously more ounces are going to come in. You're going to see that even as recently the last resource was done in 1973. Obviously, that was the 3-year trailing price average. We will be using the 3-year trailing price average for gold on the next resource update. So you'll see that movement with the price of gold as well. But the important thing to note is, you know, we're looking at sort of the Dolphin Cleary zone, and now that sort of that western extension. It really has got a great name now. I mean, it was supposed to be West of Willow. That was the acronym. It now is just WOW. So you look at some of those numbers, and it's like appropriately named. But then as we go west, we still have another 1.5 kilometers of soil geochemistry that we want to test. And that's before we get into sort of the middle of the project where we've got things like the American Eagle. Again, if you look at some of our maps, you'll see all these little pink veins. Those are map surface veins. Again, strong geochemistry. So we've got these historic high-grade underground producers scattered throughout the project.
Right.
So there's definitely more and more potential to this project. You look at the placer production from these streams, 6.75 million ounces of placer gold from the streams that drain this project area. You're still only ever looking at, and those are those hills, you're still only ever looking at 500,000 ounces of low gold production in that. So I think there's ample opportunity for additional discovery. We don't want to sell it short. But in doing that, I also want to make sure that we get our ounces valued correctly. And that's the idea of the additional metallurgy and upgrading of the resources. Because I think there is a point, you know, you do value an inferred ounce versus an indicated ounce at different levels. So I think that's what we're trying to do.
Right. So the last time I looked at exploration companies like yours, the average value of the gold in the ground was like $12, which is just insane.
It is.
It costs $50 to $60 on average to find gold.
Well, we do it for about $4. So I like to think that, you know, we're in a class of our own that way.
Yeah, but for the entire world, I guess, you know, you're lucky if you can find, if you start a new company and you just drill, it's going to cost you about $50 to find an ounce of gold. And the valuation, so it's mismatched. My point is that you have a complete mismatch on how much it costs to find gold and how much it costs to sell it for. So I think it's all going to go about 3x. We're going to get a revaluation where it'll go into the 30s. So 12, 24, 36. But I think we're going to get into so your company, I think, will just triple in value just on the rising boat alone.
Yeah.
But that's just on the rising tide. Then you're going to then the premium will kick in. The premium is the rarity.
Yes.
Your project is super, super rare. So it should double again to $70. And so my expectation is that will happen to your company just, you know, fairly soon. It just whoosh upward. And then at that point, that's when companies will come in and offer you 100% premium. And then it goes to like 100, 125, 150 an ounce. That's my vision of your company. So in other words, you don't do a thing. All you do is drill, and it goes to $70 an ounce. I think that's what's going to happen. But your PFS, how many of those ounces do you think you're going to include? Because it's massive.
Well, that's the idea right now, is upgrading that inferred into the indicated, you know, looking at where that smaller starter looks like. So it's really early days for us right now. But just to your point, I mean, we're already seeing some strong support and shareholder interest in this. You know, in April, of course, we raised $42 million. You know, Eric certainly took his pro rata share at sort of that 29%, but the rest of that was institutional. So it was really nice to see sort of the bigger names starting to recognize the asset for what it is and the company. And I think everybody is, you know, we're really excited about this year's drill program. I mean, 30,000 meters it's going to be a big program, but it's also going to be very all encompassing. There's archaeologists, paleontologists, culturists, all of the necessary work. So the idea here is, again, de-risk it as much as possible, command premium for it at the end of the day.
Right. And so one of the things about the PFS is one of the reasons why you're doing it, because you're not building it. The reason why you're doing it is to show value in the project itself. And so one of the things that you're going to do in there is you're going to try to show an ASIC and you're going to try to show a recovery rate. Those are two critical data points.
Yes.
And why are you doing a PFS instead of PEA?
Well, I think largely a PEA has a valuation. It's always a plus or minus 30 to 40% variance, right? So I think it's I mean, obviously we'll be doing it internally. It's an interesting exercise, but I think you also set a market expectation for what it is or what it isn't. I mean, most people never build for under what is proposed. And so if you haven't done the level of detailed work that you wanted to, you may sell yourself short. So the idea is, again, let's try and button it up as tightly as we can. Obviously, there's still going to be changes. It's still only pre-fees.
Right.
But the idea is to try and get a real understanding of what the path forward for the project is.
Right.
And I certainly think it's a project that supports going ahead and doing this.
Okay, excellent. The final area I want to talk about is the metallurgy and the difference between yourself and Fort Knox. So the Fort Knox mine has mine life only about 5 years left in it. And that mill is like a perfect fit for you because it's sitting 5 miles away. Mm-hmm. And the pit is ideal because you can just fill it up. It's like the pit's just sitting there. It's like all the tailings, you just stick it in the pit. Yeah. I mean, it's almost seamless. But the one thing that isn't seamless is the metallurgy. So I understand metallurgy isn't quite the same. What is the difference in the metallurgy between the two projects?
So Fort Knox has almost no sulfide. So we certainly have a sulfide component. And that's where you see that difference between when we get to that sulfide concentrate, having to oxidize that. That's the difference between our 72 to 90%. So it's having to look at that. That being said, it's not that difficult to add something to that. But I'm not going to speak to, obviously Fort Knox. They've done a fantastic job. They've got mine life till 2030. But, I say to people, it's the Energizer Bunny. I mean, Fort Knox has had mine life, but it's kept going and going. And they've done a tremendous job with what they've done as an asset there. I think, the innovation they've shown with the Valley Leach, sort of how they've lowered their cutoffs and how they've continued to grow, even with the most recent, the haul from Mancho. I mean, they've been very innovative.
Right. That's interesting. They have zero sulfides.
It's less than 1%.
Wow.
So all of their gold is actually fracture controlled. So they blast it and it comes free.
But your metallurgy isn't that bad. I mean, you said just flotation alone was over 70%.
Oh, exactly. I mean, and so that's where I'm saying there's the optionality, right? Yeah. So when you're starting to look at, but I think you have to look at the size of the deposit. So, if you look at the size, the number of ounces you're leaving off the table between 72 and 90, it's worth doing the trade-off study to see what happens.
Right. Okay. Yeah, fantastic story. I personally think it's going to be at least 35 million ounces. You're 22, but I mean, if you look at these recent drill results, man, I mean, you had over 200 meters at over a gram. I mean, you're adding a lot of ounces.
We add significant tonnage. There's no question with every round. But I'm also excited about some of those, those 20 meters of 6 grams, and even if you cut it, it's still 5.8. Yeah. So I think those are the sweeteners that come into play.
Yeah, I did have one other question. So it's basically one huge open pit, but these high grade zones, isn't that open for underground mine?
Well, I think, ultimately you may look at that, but right now we're trying to figure out where we're going to start. And so that's sort of some of this infill drilling. Obviously, there's pockets of the deposit, and there's pockets of the deposit that have better recoveries as well, too. So if you look at some of our MET results, if you were to look at just the gravity and CIL, you can get up to over 80%. So again, it's trying to sort of window out where these areas are and how we start. So that's, again, going to be a part of the engineering studies that we do.
Right. Do you think that you might, so because Fort Knox is such, a beautiful, oxide mine, and it was simple to mine, if you will, yours is a little more complex. Mm-hmm. So do you think that you'll get knocked for the complexity of your mine?
And I think that's where the de-risking comes in. I think if you can show a clear pathway, I don't think you get knocked. I think if it appears muddied in the waters and people can't quite understand how you go about it, that's where I think the risk is. So I think, our goal is to say, no, it's pretty straightforward. You do this, then this. And I think that's really what the equation is right now.
Excellent, excellent. So I think people learned a lot from this interview. And we'll end it there, but thank you so much.
All right. Well, thank you very much for the time and appreciate your support.